Good morning and welcome. In financial markets today, silver prices reached a notable high of $87.45 per ounce during Thursday morning trading, following a sharp decline the previous session that saw prices fall to a low of $84.46 that represents a recovery of nearly $3 within a single trading session, a move that has drawn significant attention from market analysts and investors alike. The price swing originated on Wednesday, March 11th. When the United States Bureau of Labor Statistics released its Consumer Price Index report at 8:30 in the morning Eastern Time, the headline CPI figure came in at 0.4% month-over-month, while the core CPI reading posted at 0.3%, both figures coming in above consensus analyst estimates. Financial media outlets responded swiftly, with major networks framing the data as a signal that the Federal Reserve would be unlikely to pursue near-term interest rate cuts. That narrative contributed to a broad sell-off across precious metals markets, with silver absorbing particularly heavy downward pressure throughout the Wednesday session. By the time New York trading concluded on Wednesday, silver had declined by approximately 3% from its Tuesday closing price of around $86, touching that intraday low of $84.46. The sell-off was accompanied by elevated trading volume, liquidation across the futures complex, and margin calls issued to leveraged long positions. Market data indicated significant activity in paper futures contracts throughout the session. However, when Asian markets opened overnight, a markedly different pattern emerged. Buying activity on the Shanghai Gold Exchange contributed to a substantial price recovery, ultimately lifting silver to that Thursday morning high of $87.45. The speed and scale of that overnight reversal has placed the mechanics of global silver trading and the relationship between paper futures markets in the West and physical settlement markets in the East at the center of today's market conversation. To fully understand the significance of Thursday's price recovery, it is essential to examine the sequence of events that unfolded beginning Wednesday morning. At 8:30 Eastern Time, the Consumer Price Index report was released, showing inflation running above market expectations. The headline figure came in at 0.4% month-over-month, with core inflation posting at 0.3%. Financial news networks responded immediately. Reporting described the data as a signal that Federal Reserve rate cut expectations had been dealt a significant blow. Analysts appearing on major financial television networks argued that precious metals face headwinds in a sustained high interest rate environment. Algorithmic trading systems, which process sentiment data and news headlines at high speed, began executing sell programs shortly after the report's release. Silver prices deteriorated rapidly. From a Tuesday closing price of approximately $86 per ounce, the metal declined to an intraday low of $84.46, a drawdown of roughly 3% within a single session. Trading volume was described as massive, with widespread liquidation recorded across the futures complex. Margin calls were issued to investors holding leveraged long positions, adding further selling pressure as those positions were forcibly closed. The combination of algorithmic selling, margin-driven liquidation, and negative media sentiment created conditions of acute market stress throughout the Wednesday session. However, a critical question emerges when examining the structure of that sell-off: who was absorbing the silver contracts being sold into the market at $84? When large volumes of futures contracts are sold, there must be buyers on the other side of those transactions. According to market analysis of the overnight session, the answer lies in Eastern Hemisphere markets, most notably the Shanghai Gold Exchange, which operates on a physically settled basis rather than the paper contract settlement model that characterizes the New York futures market. This distinction between paper and physical settlement is central to understanding the divergence that played out overnight. In the New York futures market, the vast majority of silver contracts are rolled over or cash settled at expiration, meaning the underlying physical metal rarely changes hands. Contracts represent promises of future delivery, and the system is structured in a manner that historically discourages participants from exercising physical delivery rights. By contrast, the Shanghai Gold Exchange settles transactions in physical metal actual silver bars that are transferred and removed from inventory. China's financial position added additional context to the buying activity observed overnight. Chinese customs data released recently showed the country recorded a monthly trade surplus of $214 billion, described as the highest monthly surplus figure in the history of that data series. That surplus represents a substantial accumulation of foreign currency reserves, primarily United States dollars, which must then be allocated across various asset classes. Available options include United States Treasury securities, currently yielding approximately 4.3%, euro-denominated bonds, or hard assets such as precious metals that carry no counterparty risk and cannot be created through monetary policy decisions. With that financial backdrop in place, Thursday morning's price action begins to take on a clearer shape, and the implications for the funds that were holding short positions at $84 became increasingly severe as the overnight session progressed. when Asian markets opened Wednesday night and began accumulating silver at the $84 level. The consequences for funds that had established short positions during the Wednesday sell-off became increasingly serious. To understand why, it is necessary to examine the mechanics of short selling and the specific financial dynamics that unfold when a shorted asset moves higher rather than lower when an investor or institution shorts a futures contract. They are borrowing and selling that contract with the expectation that the price will decline, allowing them to repurchase it at a lower price and pocket the difference. The trade is profitable only if the price falls. If the price rises instead, the short seller incurs losses, and critically, those losses are theoretically unlimited because there is no ceiling on how high a price can move. To maintain a short futures position, the holder must keep a margin balance with their broker. If the price moves against the position, the broker issues a margin call, demanding either additional capital or closure of the position. If neither condition can be met, the broker forcibly liquidates the position by purchasing contracts at market price. That purchasing activity itself creates upward price pressure, which can trigger further margin calls on other short positions, generating a self-reinforcing cycle known as a short squeeze. Market analysis provided specific figures to illustrate the scale of losses involved. Consider a hypothetical fund that shorted 1,000 COMEX silver contracts at $84 per ounce. Each COMEX silver contract represents 5,000 ounces of silver, meaning 1,000 contracts represent 5 million ounces. At $84 per ounce, that position carried a total value of $420 million. With a margin requirement of approximately 10%, the fund would have posted roughly $42 million in collateral to back that position. When silver moved to $87 per ounce, the position's value rose to $435 million, generating an unrealized loss of $15 million. Against a $42 million collateral base, at that point, brokers would issue margin calls demanding additional funds, and funds unable to meet those calls face forced liquidation of their positions. Multiply that scenario across multiple funds that established short positions during Wednesday's sell-off, and the aggregate losses reach into the billions of dollars, with forced buying activity contributing directly to the price momentum observed Thursday morning, including that high of $87.45. Against this backdrop, several additional data points provide important context regarding the broader structural condition of the silver market. COMEX registered inventory, meaning silver that is formally available for delivery against outstanding futures contracts, stood at approximately 43 million ounces as of last week, according to publicly available data published daily by the CME Group. However, open interest in the silver futures market represents over 150 million ounces worth of paper claims against that inventory. That ratio means that for every single ounce of physical silver held in registered COMEX vaults, there exist approximately 3 ounces worth of outstanding paper contract claims. A leverage ratio that carries significant implications if a meaningful number of contract holders were to simultaneously demand physical delivery. Furthermore, physical silver premiums at retail dealers have been widening throughout the current week. Premiums represent the difference between the published spot price and the actual price consumers pay when purchasing physical silver from dealers. Reports indicate premiums stood at approximately $3 over spot on Monday, $4 on Tuesday, and $5.50 on Wednesday. The expansion of that spread is considered a signal that physical demand is outpacing what the paper futures price alone reflects, with dealers adjusting their pricing to account for anticipated inventory replacement costs. The Commitment of Traders report, published weekly by the Commodity Futures Trading Commission, added another layer of context. The most recent report showed commercial traders, the large institutional participants that include major banks, holding their most net short position in over a year, representing hundreds of millions of ounces worth of paper contracts on the short side. Historically, commercial traders are considered informed market participants. However, analysts note that the effectiveness of paper short positions depends on the availability of physical metal to fulfill delivery obligations, a condition that becomes increasingly strained as registered COMEX inventory declines and physical metal continues to flow toward Eastern markets. As of the time of this report's recording, silver was consolidating in a range between $86 and $87 per ounce. Having pulled back from the Thursday morning high of $87.45, market participants are closely monitoring the $87 level, which represents a key technical threshold where significant sell orders and stop-loss clusters are concentrated. A sustained close above that level would trigger bullish signals across multiple technical indicators, including a crossover of the 50-day and 200-day moving averages, confirmation on the relative strength index, and expansion of Bollinger Bands, all of which would activate automated buying programs from momentum-driven institutional funds. To fully appreciate the significance of what has unfolded in silver markets over the past 24 hours, it is important to place Thursday's price action within a broader historical and macroeconomic context. Silver E's all-time nominal price high of $50 per ounce was recorded in 1980, 46 years ago. Adjusted for inflation, that peak is equivalent to over $180 in today's purchasing power terms. At Thursday's trading levels of approximately $87 per ounce, silver remains more than 50% below its inflation-adjusted historical high, a fact that some analysts argue stands in contrast. Two characterizations of current price levels as representing speculative excess. On the demand side, global silver consumption reached a record 1.2 billion ounces in the most recent annual data. Industrial demand is at an all-time high. Driven by applications in solar panel manufacturing, electric vehicle production, and consumer electronics, investment demand has also been rising. On the supply side, analysts note that ore grades at major mining operations have been declining, raising the energy, labor, and capital costs required to extract silver from the ground. Some industry observers argue that current price levels do not adequately support the economics of new mine exploration and development, suggesting the cost structure of production requires prices in the range of $100 to $150 per ounce to justify meaningful capital investment in new supply. The macroeconomic backdrop adds further layers of context to the current market environment. The Federal Reserve's benchmark interest rate currently stands at 5.38%, representing a 23-year high that has been maintained for over a year. The United States national debt stands at $36 trillion. With an annual deficit running at approximately $2 trillion and a debt-to-gross domestic product ratio of 130%, unfunded liabilities across Social Security, Medicare, and government pension obligations are estimated to exceed $200 trillion. The yield curve remains inverted. Commercial real estate markets are under stress, and regional banking sector pressures have been documented throughout the current cycle. Earlier this week, the Bank for International Settlements, the institution that serves as the central bank for central banks, globally released a report warning of potential instability within private credit markets. The private credit sector, estimated at $14 trillion, operates largely outside traditional banking regulation and encompasses leveraged lending arrangements between hedge funds, private equity firms, and other non-bank financial entities. The BIS report indicated that sustained high interest rates and rising refinancing costs could generate a liquidity shock within that sector. Analysts tracking Wednesday's silver sell-off noted that forced liquidation by private credit participants needing to raise cash quickly may have contributed to the selling pressure observed during that session, meaning the decline may have reflected credit market stress rather than a fundamental reassessment of Silver's value. China's role in the current market dynamic extends beyond Wednesday's overnight buying activity. The People's Bank of China has been a consistent buyer of gold reserves for over a year, officially adding more than 300 tons to its reported holdings during that period. China's dominance across several strategically significant industrial supply chains, including rare earth elements, solar panel components, and battery materials, has been well documented. The conversion of trade surplus dollars into hard assets, including precious metals, represents a continuation of a pattern that multiple sovereign actors across the BRICS economic bloc have been executing as a response to concerns about the long-term purchasing power of dollar-denominated reserves. The historical parallel most frequently cited in relation to the current setup is the period between March 2020 and August 2020, when silver moved from approximately $12 per ounce to $30 per ounce in 6 months, during a period of acute credit market stress and aggressive Federal Reserve monetary expansion. During that episode, the COMEX was compelled to emergency expand position limits in response to strains in the physical delivery system. Market observers note that the current base price of approximately $87 represents a substantially higher starting point than the $12 base of that prior episode, while the macroeconomic conditions, including total Federal Reserve balance sheet expansion of $14 trillion since 2020 and federal debt growth from $23 trillion to $36 trillion over the same period, represent a significantly more expansive monetary backdrop. To summarize the key developments from today's session, silver recorded an intraday high of $87.45 on Thursday morning, following Wednesday's decline to a low of $84.46. The Wednesday sell-off was triggered in part by a consumer price index report showing headline inflation at 0.4% month-over-month and core inflation at 0.3%, both above consensus estimates. Overnight buying activity on the Shanghai Gold Exchange contributed to Thursday's price recovery. COMEX registered inventory stands at approximately 43 million ounces against over 150 million ounces of outstanding paper contract claims. Physical silver premiums at retail dealers have expanded throughout the week, reaching $5.50 over spot on Wednesday, the most recent commitment of traders report shows commercial traders at their most net short position in over a year, and the $87 level remains the key technical threshold that market participants are monitoring for directional confirmation. Going into the close of Thursday's session and the end of the trading week, this has been a comprehensive look at one of the most closely watched commodity market developments of the week. The interaction between paper futures markets, physical settlement exchanges, macroeconomic data releases, and global capital flows has rarely been more visible or more consequential than in the past 24 hours of silver trading. We will continue to monitor developments as Thursday's session progresses and bring you updates as the situation evolves. Thank you for watching.